It's Friday the 25th of October, and this is your Capital Economics Weekly Briefing. David Wilder here, coming up, a special UK budget preview and a policy shocker from Ottawa. But first, Neil Shearing is here to give us the lowdown on another action-packed week in macro and markets. How's it going, Neil?
Hi, David. How long have you been working on the policy shocker from Ottawa? I like it.
Good 10-15 minutes, but I think 10-15 minutes well spent. Yeah. Let's start with the bond market. We've got to, don't we? The 10-year Treasury yield last at 4.2%, so back at July levels. Now, let's talk about what's been happening, certainly at the long end, and how that's linked to Donald Trump looking better in the polling. Others say, no, this is just a repricing of Fed rate cut expectations after that giant September payrolls number. So is it either of those things? Is it both of those things? Or is it something else entirely?
I think it's a bit of both of those things, really. If you look at the incoming data over the past month or so, broadly consistent with a soft landing in the US economy, but on our macro scenarios dashboard, we've nudged up the probability of a no landing and nudged down the probability of a hard landing. So all other things being equal, that's bearish for bonds and means higher yields. But you're right too. I think there's an election factor going on here. And it's not just the outcome of the presidential election, but also the down ballot races, the possibility of a Republican clean sweep. The market's starting to price in a higher probability that might happen. That might mean looser fiscal policy, more tax cuts. That means higher bond yields too. And that's manifesting itself in slightly different ways. So it's partly through an upward revision in the expected path to short-term interest rates, but also the term premium has increased a little bit too.
Does that imply that we're going to get more decisive moves after the election? Yields this time last year were around 5%. Is there a risk that we're going to see them testing those levels again?
Yes, I think there is a possibility, again, dependent upon the election outcome. In fact, we're going to be publishing a major report over the coming days looking at exactly the different types of market scenarios that could play out in the wake of the election. But I think a key point to bear in mind here is markets are by definition a weighted probability of various different outcomes. So if a Trump victory is bearish for bonds, then that's only partially priced at the moment, given there's 50-60% probability of it materializing. So you would expect to see yields rise a bit further in the event that outcome actually materializes. Conversely, I think if Harris wins, then perhaps yields start to edge back down. But yeah, essentially, because the market at the moment is pricing a weighted average of different probabilities of outcomes, but the outcome of the election itself is binary, then by definition there's some scope for market moves after the election. And as I say, we'll have more to say on that in a forthcoming piece.
What about nearer term and what's happening at the short end? I did mention this relatively big move up in yields that we've seen seem to be triggered by that September payrolls number. We've got October payrolls in the coming week. What's the risk of another blowout number?
Well, there's always a risk of a blowout number. I think in this instance, actually, the risks lie perhaps on the downside. So we've seen in the October numbers, we'll get both a hurricane effect on employment, but also the effects of various strikes, including at Boeing. And then put all those together, we think that if you look at the broad sweep of history, payrolls tend to be about 20 to 50,000 lower in the month following hurricanes of a similar magnitude to those that were experienced in September and October. The Boeing strike probably knocks something similar order of magnitude off the head of the payrolls number two. So we've penciled in a 100,000 gain in payrolls for October, but I think that there's quite a wide margin of error around that number.
Okay, taking a step back, with all that's going on in the bond market, I mean, yields on other government bonds have been going up as well. Perhaps have been dragged up by what's been happening in treasuries, but how much of this does this speak to worries about a deteriorating global fiscal picture? And I ask because the IMF was out this past week talking about how global public debt is going to exceed $100 trillion by the end of this year, which is obviously a very, very big number. But then what? For all the talk of bond vigilantes, markets don't really seem too fazed about all of this unless something goes wrong on the political front.
I think that's exactly right. It's very easy to find scary numbers, large scary numbers on the fiscal front. But what's holding public finances together is really this conceit between governments and bond investors, which is that we get that deficits are large at the moment, investors are saying, but we trust that the governments are ultimately going to toe the line. They see the need to be fiscally responsible. Hence, I think that's how you can square the fact that you can run these large deficits and high levels of debt, while at the same time having extremely low rates of term premia in bond markets, and essentially bond yields remaining pretty well anchored. The trouble, I think, is knowing at what point does the bond market's patience start to run out. And there's a few lessons from history, in particular what happened here in the UK of the trust debacle, which I know you'll talk about later, with Paul and Ruth on the UK budget. But I think that the key message for me from that episode was that fiscal responsibility is kind of hard to earn and easy to lose. And it doesn't necessarily take much in the way of policy substance, but it's as much about the kind of tone and optics of what the government says and does that can rattle the bond market. So I think the critical thing to keep in mind is not so much what governments are doing, but what they're saying and how the messaging is evolving around fiscal policy. If they continue to talk up the need to be fiscally responsible, the importance of fiscal rectitude and so on and so forth, then I think this just about holds together. If, on the other hand, they start to dilute the importance of fiscal responsibility and start to talk in more populist tones, then I think things could get pretty messy quite quickly.
Linking back to your point there about who wins come November, I noticed there's a headline of Trump musing again, in this case, about scrapping the income tax altogether and having tariffs fund the federal budget. But we're going to be previewing the US election in next week's podcast. I'd like to stay for now on this question of fiscal rectitude. I want to bring up the example of France, because here you've got an economy with a gaping deficit. You've got a credible new PM who's got a plan to cut that deficit. And the market's response has been pretty meh, hasn't it? I mean, in fact, the way that French bonds are trading, they seem to be closing in on what's happening with Greek bonds. What is the story there? What does that tell us about how governments are meant to tackle this fiscal issue?
Well, I think one of the lessons is that once the fiscal genie starts to get out of the bottle, it's really difficult to force it back in, if that's the right metaphor. But you have a credible PM, as you say, but the government itself is pretty weak, and there's some doubts as to the extent to which it can force through some of these fiscal tightening measures. I think the other point is that France is finding itself in a position of having to tighten fiscal policy at a time when its economy is extremely weak. And obviously, fiscal tightening is negative for growth. It's a headwind to growth. So it pushes down on growth. So we've now reduced our forecast for GDP growth next year to just 0.7%. And that makes fiscal consolidation harder because you're consolidating it against a backdrop of economic weakness. So a couple of things going on. It's partly about you can have a government that talks a good game, but if they can't force the measures through the legislature, then the market will be skeptical. And if you're doing it from a position of weakness, economic and political weakness, then the market will be skeptical too. And I think that helps to explain the reaction in French government bond markets, as you say.
Okay, I want to stay on Europe because I talked about the IMF before. They've also had their latest global growth forecasts out this week. US upgraded, Europe downgraded. This story of US outperformance, does it change depending on who's in the White House come January?
Well, I think it's tempting to say that it doesn't, because when you look through the broad sweep of history, presidents come and go, governments come and go. It's not just true of the US, it's true of other countries, and they don't tend to have, it's very rare that they have a big impact on economic prospects, particularly from 1 year to another. So I think it's tempting to say, actually, it doesn't matter. And I think by and large, it may not matter if Harris is elected president. But the range of different outcomes under a Trump presidency, I think, is much larger than is usually the case. So the tails, if you like, are much longer. Now, it could be the case that all of the measures, or many of the measures that Trump's been talking about on the campaign trail, large tariffs, 100, 200, 2,000%, as we talked about last week, it could be the case that that's just a bargaining chip, and in practice, they're not pursued. They don't make it through to a policy for government. Likewise on immigration reform too. However, if you took the totality of all of those policies, and if it came alongside a broader shift towards US isolationism, then I think, not just economic isolationism, but political, geopolitical, military isolationism, then I think actually that does start to move the dial at a global level. I don't think it necessarily means that China's bound to overtake the US as the world's largest economy, but I think some of the narrative around fracturing that we've talked about with this US and China block emerging, then maybe the edges around those blocks start to become a bit fuzzier, and maybe Europe starts to go in a slightly different direction. So I think it does have, the outcome of the election does have the potential to reshape the narrative around the global economy over a 5-10 year period. That's across many different areas, but also including US growth. And if we were to get some of the more radical policies that Trump has talked about on the campaign trail enacted in practice, then as we've talked about in our research, US level of GDP would be lower, inflation would be higher. And so clearly that starts to put a dent in the narrative about US exceptionalism and outperformance.
Neil Shearing there on US economic outperformance, the global debt pile, October payrolls, and more. I'll add our October payrolls preview to the podcast notes, along with a new report from our chief markets economist, John Higgins, on how the bond market is weighing up the risk of a US fiscal crisis. Staying on a fiscal note, the coming week is a big one for the UK economy, with Rachel Reeves set to make her debut budget statement to the House of Commons. The main event is on Wednesday, and our UK team will be online shortly after for a drop-in. That's one of our short-form online briefings to take your questions and highlight the key takeaways from Reeves' plans and their macro and market implications. Paul Dales, who leads our UK team, and Ruth Gregory, our Deputy Chief UK Economist, have been briefing clients on what to expect in the run-up, and they sat down earlier this week to talk through the main issues around this budget and what it could mean for the UK outlook. Here's that conversation now, and it starts with Paul.
So the budget on Wednesday is the first of the new government, and it's an opportunity for the government to set the scene of how it's going to run the economy and what it wants to achieve. Now, in the run-up to the budget, all that positivity that we saw soon after the election seems to have disappeared, and instead business confidence is down, consumer confidence is down. There's rumours people are selling assets and leaving the country ahead of possible tax hikes, and lots of evidence that businesses are putting on hold decisions until after the budget. So, Ruth, can you talk through why we don't think the budget as a whole will be as bad as some people fear?
Yeah, sure. I think with all the government's talk of black holes and funding gaps, there is a perception, isn't there, that the budget will be pretty bad news for the economy. And it's no secret that taxes will be raised. If we're right in thinking that the Chancellor will raise 25 billion in tax revenue, that would make this the third biggest tax raising budget since the early 1990s. So I think it's clear that the budget will be bad news for those households and businesses that bear the brunt of the tax rises. But as you mentioned, this isn't the whole story. The Chancellor is likely to use the revenue raised from higher taxes to increase day-to-day spending. So that's spending on goods and services that the government needs to buy and the wages of public sector workers. And if higher taxes are matched by higher public spending, then for the economy as a whole, the overall effect is likely to be pretty limited. And the Chancellor has suggested as well that she will redefine her fiscal rules to allow her to borrow more to fund public investment. And that would be a new injection of money into the economy. And crucially, since it's targeted at growth-enhancing investment, it could really lay the foundations for stronger economic growth in the future.
Well, let's explore that a little bit more. So a lot does depend on the shape, size and timing of the policies that are actually announced in the budget. But can you explain how we think the budget will actually influence our economic growth forecast, that the economy will enjoy an acceleration in growth to about 1.5% next year, and also our bank rate forecast that bank rate will fall from about 5% now to perhaps 3% by sometime early in 2026?
Yeah, I think if she raises public investment in the budget as we expect, that might prompt us to revise up our near-term GDP forecasts. So we think she may ramp up public investment perhaps by about 18 billion, and the result may be that GDP growth in 2025 may accelerate to nearer 2% rather than our current forecast of 1.5%. But I think the other consequence of more public investment is that over the next couple of years, inflation might be a bit higher than otherwise, and interest rates may not fall as far. So to put this into numbers, instead of bank rate falling from 5% now to 3% in 2026, if other things were equal, then interest rates may be about 40 basis points higher. So interest rates may be cut to 3.4% instead.
Well, that's certainly relevant for the financial markets, isn't it? And we've seen that gilt yields have been rising over the last few days and weeks, mostly for global reasons. But what are the chances here that the Chancellor gets the balance wrong between wanting to boost public investment but using increased borrowing to do so? I mean, is there a risk that there's something similar to the Liz Truss episode of 2 years ago where gilt yields spiked and the pound fell? I mean, surely that's what some investors are really worrying about.
Yeah, I think Reeves and Starmer have so far, they have gone out of their way, haven't they, to reassure the bond market that they've learnt the lesson from the Truss quartering episode in 2022 and that the government's committed to fiscal discipline. And the budget will be very different in I think, both substance and style to that infamous mini budget. The substance is that in the mini budget, borrowing was raised to pay for one-off tax cuts, which were never going to increase the size of the economy in the future. And in this budget, borrowing more to invest, that could lead to a bigger economy. And then the style is that, of course, Liz Truss sidelined the fiscal watchdog, the OBR, and essentially did away with the fiscal rules, whereas in this budget, the fiscal rules, yes, they may be tweaked to allow more public borrowing, but the OBR will still cast its judgment and the government still appears committed to a fiscal discipline. Having said all that, I think it is clear, isn't it, that the Chancellor does face quite a delicate balancing act between achieving her political objectives with the objective not to appear fiscally irresponsible. And if the rise in borrowing to fund investment, it's broadly in line with our expectations, then I think that's something that the market's probably already braced for. But if the Chancellor goes further and tries to get a big political win now, and she's more willing to sail close to the wind and take a bit of a risk with the bond markets, I think that the budget does carry at least some risks for the gilt market if she goes a bit further there. And if there were a big rise in borrowing than we expect, then clearly that could increase market nerves over the sustainability of fiscal policy and risk sharp upward moves in market rate expectations and gilt yields, as well as perhaps a fall in the pound.
It's worth, I think, stepping back to and thinking about the bigger picture. So, let's think about what kind of signal this budget is sending to the world. It feels to me that for the first time in a long time, actually, we might be sending quite a nice positive signal to the rest of the world in two ways. So it's not obvious that there's really a big handbrake on the UK economy anymore, like that has been for much of the last 18 years with the rolling restrictions from the global financial crisis, the years of austerity, Brexit, pandemic, cost of living. There are risks out there, but we don't have that really big obvious handbrake right now. And for the first time in a long time, we seem to have a government that is really trying its best and intending to boost economic growth and hopefully put in place a bit of political stability, which we haven't had for a while as well. So it might be that the stars are aligning here, both economically and politically. And it could be the case that that's happening in an absolute sense, but also for the UK relative to some other countries such as France and the US, where you could argue that economic, fiscal and political issues are actually becoming a bit more concerning. I mean, to be honest, before the new government came in, Capital Economics had this quite optimistic view that the UK's long-term or medium-term growth prospects were going to improve, perhaps with economic growth accelerating from something like a norm of 1.5% this decade to something like 2% or maybe 1.8% in the 2030s. Now, to be clear, that's not because of the new government's reforms. We think the new government's reforms and stance on the economy might be an upside risk to that. Now, obviously, we won't find out the answer to that on Budget Day next Wednesday, but we might get a sense of the direction in which the government is going and where it's going to take the UK economy.
Paul Dales and Ruth Gregory on the upcoming week's budget. I will link to our dedicated budget page on the podcast notes where you can read the key analysis and sign up for our post-budget drop-in. Now, the economists at Capital Economics day to day, for the most part, watch incoming data flow, track what policymakers are saying, speak to people in the market, and make tweaks to their core views and forecasts. But every now and then, something happens that makes them basically tear up those forecasts and start all over again. And it's not just global events like war and the pandemic. This past week, Justin Trudeau, Canada's embattled PM, announced new immigration targets which are aimed at slashing the numbers of people coming into the country. Our Canada team was still basking in the glow of getting their, until recently, very non-consensus Bank of Canada 50 basis point cut forecast correct when the news hit and they've basically binned their growth assumptions in its wake. To find out why, I spoke to Stephen Brown, our Canada research lead. Here's that conversation now, and it starts with Stephen on what's been announced.
So we always get targets for permanent residents, but the big change this time was that government is now targeting temporary residents. So this is, for instance, people that come to Canada to work for a couple of years, or international students, those types of people. And that group, the temporary residents, have been behind the big surge in immigration we've seen in recent years. But the government now wants to bring those numbers down, and down a lot more substantially than it previously hinted. So it wants to bring the share of temporary residents down to 5% of the population from about 7.3% currently. And this essentially means that the number of temporary residents needs to fall by almost 1 million over the next couple of years to reach that target by the end of 2026, as the government has outlined. So that implies overall that we're likely to see the population fall by 0.2% in 2025 and 0.2% again in 2026, which is a huge change from what we were expecting. So our population growth forecasts were actually already below consensus, but we were still expecting positive growth of close to 1% really each year. So it's certainly a big change.
As you say, this is massive U-turn, isn't it? Canadian immigration numbers have been stunning since the pandemic. Is it nearly 3 million people coming into the country? What has all of this meant for the performance of Canada's economy?
Yeah, exactly. So we've had population growth of almost 3% year on year for 2 years straight, which is obviously a huge number of people. And it's really been the big factor keeping the economy afloat. So the Canadian economy, we always expect it to be more sensitive than most to higher interest rates because consumers tend to have a very big share of variable rate debt, particularly in mortgages. The economy did manage to avoid a recession largely because immigration was so strong. So we've seen, for example, GDP per capita, consumption per capita fall to the lowest in about a decade, but the overall spending numbers were kept afloat by this pure kind of boost to the aggregates in terms of people coming in. But that means now we're going to see population growth swing from 3% year on year for 2 years to minus 0.2%. And this is the first time in Canada's history since 1870 that the country will be dealing with negative population growth. So it really is just a monumental change.
I was reading your instant reaction last night, and the basic message there is you guys had a view on Canada. Now we get this policy U-turn. You've effectively torn up your forecasts, haven't you? So I know you're still formulating new forecasts based on what's been announced, but give us a sense of what these changes could mean for the macro variables, but also in terms of, the things like house prices and those resources that we've seen strained by this influx of immigration.
Yeah, so there's kind of two parts to it. So one is the impact on potential GDP growth. So when we think about the extent to which an economy can grow over time, it's normally labour force growth plus productivity growth. So obviously, if we have much weaker immigration, we're going to have much weaker labour force growth. Now, there is a bit of debate about to what extent high immigration might have weighed on Canadian productivity in recent years. It's actually been negative for years now. So perhaps the reduction in immigration will be offset to some extent by slightly stronger productivity growth. But we still think potential growth is probably going to be no more than 1% now for the next couple of years compared to the Bank of Canada's estimate at the moment of about 2%. So suddenly you've got a much weaker starting point just from potential growth. Now, the starting point for the Canadian economy is that there is an output gap. In theory, we could see GDP growth above potential as that output gap closes thanks to looser monetary policy. But the big risk here is really what it does mean for house prices and residential investment in particular. So residential investment has been hit very hard by high interest rates. Our assumption and the Bank of Canada's assumption at the moment is that residential investment, there was scope for it to rise very strongly in the next couple of years to close that output gap. But if suddenly there's no population growth, then developers obviously don't have much of an incentive to build homes. So we're likely to see much weaker residential investment. So we're probably going to be faced with a situation where GDP remains below its potential. So not only do we get weaker potential growth, but we also don't have this catch-up effect anymore. So it's a double whammy, as it were. And again, we're worried about the downside risk because at the moment, even before this announcement, rents in the major cities have already been falling due to increased home supply and already a bit of a slowdown in immigration. House prices are not falling at the moment, but the leading indicators suggest that they will be falling pretty soon. So again, we're faced with a situation where suddenly it could be that certainly the investor part of the market, which is big in the big cities like Toronto and Vancouver, those investors might try to sell properties if they're concerned about a fall in rents ahead. And so that could create this self-fulfilling cycle where we have lower house price expectations, lower house prices, and ultimately even less new construction. And then obviously that feeds through to what does that mean for the Bank of Canada? So again, on that first point on lower potential growth, if it's just lower potential growth and it doesn't warrant a policy change, but if it's that we're not going to get this catch up, essentially because the outlook for residential investment and house prices are all weaker, then it means the Bank of Canada will need to loosen policy by a bit more than it would do otherwise in order to support other parts of the economy to try to get GDP back up to potential. So again, we haven't finalized our forecast yet, but we do think there's now downside risk to our existing view that the policy rate will end at 2.25% next year. So we could be talking about less than 2% most likely.
Talk a bit about the sort of the political environment in which this has been announced. We've got federal elections expected sometime between now and next October. The polling numbers for Justin Trudeau's Liberals looking pretty grim. No doubt this announcement was made with an eye on those numbers, but how does immigration factor into this election? And what would we expect from a Conservative government on immigration if they won? I know that Trudeau's pitching this as a pause. What would we expect going forward?
Yeah, so certainly the opposition Conservatives have very much made this forthcoming election about the cost of living. So immigration being a big factor there, given the upward impact that we saw during the pandemic on rents and house prices. Now, it's tricky here because the Liberal government have now doubled down on their prior pledge to bring immigration down with this new very kind of quite drastic policy. We don't necessarily have a good handle yet on whether the Conservatives would be happy to stick with these new lower numbers, or because they're campaigning against the Liberals, they have to double down further and come up with a completely new set of even lower population growth estimates. So, I mean, that's the risk here, that this continues to be kind of a political game with regard to the immigration targets, and we end up with even lower targets if the Conservatives do win the next election. And in that case, obviously, there'd be even greater downside risks to our forecast for house prices and residential investment and the economy. But certainly, I mean, this kind of does touch on a broader point that immigration has become a huge issue in many countries. And I think, it's a different case in Canada because immigration has been so much stronger than elsewhere. But this very much a U-turn shows that I think politicians across both sides of the political spectrum are starting to realize that although we might need immigrants, but particularly in many advanced economies where we've got very drastic demographic headwinds, you also need to make sure you're bringing those in at a very measured pace, and you're also making the investments to house and provide services for these newcomers. And frankly, that just hasn't been the case in recent years, given the sheer extent to which immigration has grown.
Stephen Brown on Canada's immigration U-turn and lessons for other advanced economy governments. After the call, Stephen noted that the market response has been fairly muted so far, possibly because no one's quite clear of what to make of all of this. Regardless, the team will be publishing new forecasts in the coming few days, so watch out for those. But that's it for this week. We will be back next week with a preview of the big event on November 5th. I refer, of course, to reality star Kris Jenner's 69th birthday. No, of course, I'm talking about the US election. We'll be talking about what to expect in macro and markets from the outcome of this vote. Until then, goodbye. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.